QuickBooks Pro Desktop 2021, add new accounts and opening balances. Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are in our Get Great Guitars practice file homepage. We currently have the open items open. You can open up the open windows by going to the view dropdown and the open windows list. Now we're going to be adding some more of our opening balances. So as we do so, let's open up our reports that we have thus far. So we're going to go to our reports dropdown. We're going to go to our company and financial. We want to take a look at the balance sheet standard to see what we've got so far. I'm going to change the dates to 12/31/20. So we want to enter our balance sheet as of this point in time. We've entered some of the key numbers that we needed to enter because we needed a subsidiary ledger to it. So we've been entering the kind of balances that we need some other report that's going to support that number. That including the accounts receivable supported by the customer list on who owes us the money, the inventory supported by the inventory list to say what type of inventory we have, accounts payable supported by the vendors, and then the opening balance in the equity section currently not correct because that's where QuickBooks is going to dump everything else until we get all the opening balances in place. Let's do that now. We're going to go back over to our beginning balance worksheet. Now note, as we enter these beginning balances, we are of course assuming that we had a accounting system that was happening before the point in time that we started using QuickBooks, and we want to put this information from our accounting system prior to this as of the cutoff date into the current system as of January 1st, 2021. Moving forward from that point going forward, any data that needs to be gotten prior to that point needs to be gotten from the prior accounting system. That's going to be kind of the idea. And even if you're starting from scratch, you probably have a couple balances that you already have basically set up. For example, you might already have some money in the business checking account before you get the QuickBooks set up. You got to add the beginning balance possibly for that. And you might have some of the other items such as some property, plant, and equipment that you're putting into the business that you need to put in that you already have, that you're not buying it, that you might want to put on the books as the business. You might have the credit card debt and so on and so forth. So let's look at what we've had thus far, and let's basically highlight the ones that we have finished already. So I've already added the accounts receivable. I'm going to make that then, I'm going to make it yellow. I'm going to make it yellow. We've done that. The inventory, we've done that. I'm going to make that yellow. So we've done that. The depreciation, we haven't done that. We haven't done this. We've done the accounts payable. So I'm going to make that yellow. Say, okay, that's done. With the Visa, we haven't done. Loan payable, we haven't done. Opening balance and the equity should figure itself out once we have finished. So now let's go to the cash up top. I'm going to make that green because that's the one we are currently working on. Green means we're working on it like right now. So there's the green. Now the checking account, it means that we're going to look at the checking balance as of the prior point in time that we're entering the data. So it's sometime, we're imagining sometime in January or sometime after the cutoff date of 2021, we want to enter the balance as of the end of that time period. So if we have our prior bookkeeping information, we need to take that information from the books in order for our trial balance to be in balance. However, the checking account will be somewhat of a problem because we do need to reconcile the checking account, and there might be some outstanding checks and deposits that could make that complicated. So we might have to, when we go to we're going to put the beginning balance in place, in other words, as of this point in time. Then when we do the bank reconciliation, which will be after the 2 months of data input, we will consider some of the added problems that will be taking place with regards to reconciling when there may have been outstanding checks and deposits in the prior period that are basically encompassed in this 25,000. So for right now, we're just going to add the beginning balances. We're going to be aware of that. And we're just going to say that's okay. We'll figure that out, when we get there. So I'm going to go back to the home tab. Now there's a couple different ways you can enter the beginning balances. You could try to do it with a journal entry at this point if you're comfortable with them or if you like them better. But we're going to do it the way QuickBooks has kind of been set up to do it. And that's going to be going from the lists when we add new accounts. So I'm going to go to the lists dropdown. So remember, this is a primary list. And remember that lists itself is a QuickBooks term. So lists are these kind of items. We're looking at the chart of accounts. Let's go into the chart of accounts, our major list. The chart of accounts is broken out, and you want to think about it as ordered by type. You can order the chart of accounts in different ways if you want to search for things in different ways, but it's best to see it as ordered by type because that's going to be the balance sheet and then the income statement ordering, and it's going to be the balance sheet in terms of assets, liabilities, equity. That's the type of accounts, assets, liabilities, equity, then the income statement. So we're going to think about the checking account. Where should that lie? And as you add these new accounts, you also want to think and remember that we have set up a chart of accounts by QuickBooks. QuickBooks has set up a chart of accounts in accordance with our industry. So whenever we're thinking we need a new account, the way we want to do it is go to the chart of accounts, see if there's an account already there set up by QuickBooks, use that account if we need to. If we don't like the name QuickBooks gave us, change the name. Just simply alter the account, going onto the account and then editing it. We'll go up and edit the account and just change the name. But if QuickBooks does not have an account, then we'll add a new one. So don't just add new accounts without checking first, or else you're going to end up with this huge list of a chart of accounts that you don't really need with a bunch of duplicate stuff, and that gets kind of messy. So we need to add a checking account. We don't yet have a checking account here, so we will add it. So I'm going to add a checking account. To do that, I got to go to the accounts drop down, which is really a rise up. So the account rise up, and we're going to go into the new item up top. It's going to be a bank account. So we have the account type now that we need to be picking up. The major account types will be up top. You want to think about it first in terms of the balance sheet and then the income statement. Second, the accounting equation, assets, liabilities, and equity type of accounts, and then income and expense type of accounts, and then more specific categories used in QuickBooks, such as bank accounts being a type of asset account, and so on and so forth. So now we're looking at the bank account. If they're not listed up top, they have some other kind of general categories on down below, which we'll take a look at as we add more accounts. So we're looking at the bank account. We're going to say continue, and we're going to set up the bank account. And so it says the account name. I'm just going to call it the checking account. Is that what we called it over here? Yeah, checking account. Checking. Now, in practice, you might have multiple checking accounts, so you might want to put a name next to it, checking account, like the last 4 digits of the account name or something like that. And that can help you to identify. It's best to do that. It's easy to do that for data input. That's really nice to do for data input, to put like the last 4 digits of the number. Not so nice for the presenting of the reports if you plan to have that checking account on there, because then you'll have an account number after the checking account, which isn't quite as nice. But you can also think about how you're going to format the accounts when you get to the balance sheet, and you could collapse some columns. So you got to come to a balance, in other words, with optimizing your accounts so you can jump to the balance sheet and use the accounts you want, and optimizing the accounts to make the best, nicest reports that you can then be presenting to a client or to whoever needs it, So then the description, we don't need really a description. It's not a subcategory. We could make a subcategory if we have multiple accounts and just say this is going to be cash, for example, and then put multiple subcategories in there, which will allow us to collapse those accounts when we make the financials. A bank account number, we could put that if we need it. We don't need it right now. It will be necessary when we do bank feeds, which we'll talk about at a future time. Routing number, I'm not going to put it in right now because I'm not looking at transactions that are going to be electronic at this point. I just want the checking account to enter the detail in it. And then the tax line item, I'm not going to put this information in here. This line item can be helpful if you are using tax software that is by the same company as Intuit uses. QuickBooks has tax software. So if you use like a Lacerte or possibly TurboTax, this might be easier to input. But honestly, I haven't seen it work seamlessly to do, so I don't think it adds a whole lot of value at this point. It might be useful later. So enter opening balance. We do need to enter the opening balance here, so I'm going to enter that. And the balance we're going to say is the 25,000, so 25,000. And then the statement ending date 12/31/20, and that's once again is as of the prior year before the cutoff period that we're going to be working on going forward, and enter. So remind me to order checks, no, and order checks. I'm not going to do anything here. Notice we will once again go into bank feeds at a later point. We're not setting up bank feeds for this checking account at this point, but obviously you need a checking account before you can think about bank feeds. And you want to understand your accounting system before you do the bank feeds, because it'll just confuse you if you have a whole lot of data due to the bank feeds without understanding how to import that data into your accounting system. So I'm gonna save this, and there is our account. So I'm gonna say set up bank feeds. Now it's asking me to set them up. I'm gonna say no. I'm not gonna set up the bank feeds. There's the checking account right up top. It's our first asset account, 25,000 in it. If I then go to the balance sheet, I'm going to say, there it is. There's the 25,000. If I double click on the balance sheet, then there's the opening balance. Notice it created a deposit type form, because a deposit type form is the type of form that will result in an increase in cash typically. And so I'm going to double click on the deposit form, and then it shows me a deposit type form, not the opening balance form we saw, because this, again, typical form for an increase in cash. Closing this back out, closing this back out. The other side most likely went to opening balance equity. So if I double click on opening balance equity, there's the $25,000. That's where QuickBooks dumped it. That account's an imaginary account, but the fact that it is in the equity section is correct. So it'll be fine. We'll just make a small adjustment, moving it from there to the capital account after. So that's going to be the checking account. So I'm going to go back on over and say, all right, we did the checking account. That's good. Let's make it yellow. Now we're done with that. And we're going to move on to the next one, which is going to be, let's do the furniture and fixture first. Now it's out of order here because these are both fixed asset type of accounts. But the furniture and fixture usually would be on top, but because it's in alphabetical order within that subcategory, the accumulated depreciation is on top. That's kind of one of the problems of not using account numbers. But well, it's okay. We're going to move forward with that. Okay, so the next one we're going to go to is the equipment. So we've got equipment or furniture and fixture. These are depreciable assets. So these are things that are going to be depreciated. I'm going to highlight that to see that that is the one that we are on at this point in time. So I'm going to go back on over to QuickBooks, and I'm going to check my chart of accounts. Now this is a depreciable asset. So if I look into my account types, it's a type of asset, and it's going to be a fixed asset. So if I look in here, I'm going to say, okay, there it is. There's the fixed asset. Now note that if I called it something other than furniture and fixture in my beginning balance, I might call it like equipment. It might be a depreciable asset called equipment. It might be a depreciable asset like building or something like that. Something that's going to be a long-term depreciable asset. Now, you could go back on over here if that's the case and change the name of this account. So you could change the name to some other name like equipment, or if you'd rather have it called furniture, or rather than furniture and fixture. But note that this account is somewhat standard because it's coming from QuickBooks. So the general rule, if you're not used to adding accounts, I would say is first look at what QuickBooks gave you for the industry standard, see if that lines up to what you think it should be. And only then move and say, okay, I'm going to change the name to what I think would be better, like equipment or some other item. Or you can add a new account if you needed to, but if you're not going to use this furniture and a fixture, it's already set up as a fixed asset, then I would simply edit the name by going to the edit screen here. And so that's what we'll do. Also note that the depreciable assets also need like a depreciation schedule to list all of the assets that you have and then depreciate them according to whatever method you will be using. Now, we're not going to set up that list here in QuickBooks because that's going to be more of a detailed process. I would assume, as is often the case for small businesses, that list could be created outside, meaning your tax software oftentimes will be giving that detailed list because they need to break that out for tax purposes to do the tax depreciation, and should be able to hopefully have software that can differentiate tax depreciation and book depreciation if you so choose. Therefore, we're just going to put the ending balance here on the equipment, what it should be, and the related accumulated depreciation, and have the detail be made outside of that, typically in the tax software for us. So what I'm going to do is I'm going to edit this account. I'm going to go to the account Rise Up, drop down Rise Up, and we're going to go to the new account. And we're going, not a new account, we're going to edit that account. Rise Up, edit the account. And then we're going to go, it's furniture and fixture, so we'll leave it there. Notice the account type is a fixed asset type of account, like a depreciable account. You might hear it called property, plants, and equipment, PP&E, depreciable assets, furniture and equipment. I'll keep the name, and then I'm going to add the opening balance. So opening balance is all we need here. I'm going to say the opening balance was $75,000. So $75,000 as of 12/31/20. So the day before the cutoff, same date we've been using, because January 1st, 2021 is going to be our date that we start. We'll say okay, and that's it. So I'm going to say save and close on this one. So the account was already there. Now it just simply has the opening balance in it. If I go back to my balance sheet, it should refresh for us. Notice if it doesn't refresh, you can just click on it or hit refresh up top. And then there is our property, plants, and equipment. It's in the asset section, property, plants, and equipment. There's the $75,000. If I double click on it, Then we see the detail. It's recorded as a journal entry. Notice it's not a form because there's no fixed form to adding property, plant, and equipment. So they have to default to the journal entry. So if we double click on the item to go to that journal entry, there's the journal entry. If I double click on this little journal entry thing right there, then it'll show the actual journal entry data input screen. This is where you go if there's no other form to enter the data, for example, for transactions that aren't everyday type transactions like the purchase of equipment. So I'm going to close this back out. We can see the other side went to opening balance equity. So that's going to be down here, other side in opening balance equity. So that's where QuickBooks just dumped the other side, and that's fine, even though that's a made-up account, because we'll just move it out of there into the proper equity account at the end of this whole process, and everything will be perfect. So now we've done this one. We've done the furniture and fixture. Let's do the related accumulated depreciation. Accumulated depreciation is a contra asset account. It's an asset account with a negative balance or like a credit balance. And that's because it's going to show the fact that we have reduced the asset, but it's an estimate. Therefore, we create this other account. And you have to net those two out to know what the book value is. So the book value is the $75,000 minus the $7,500. So this one's a little bit confusing if you don't use debits and credits, because you got to be like, well, does QuickBooks want me to put it in there as a negative number or as a positive number? Because it's an asset with like a negative balance to it. So this one's always a little bit confusing. So if we go the wrong way with it, we'll see it on the balance sheet and we'll fix it. So I'm going to go, all right, let's go back on over here and go back to the chart of accounts. So here's the other side, accumulated depreciation for the fixed asset account. Now note, as you enter this one, you might want to, it depends on what you want. You might want a different accumulated depreciation for every fixed asset type of account. So you might have equipment, furniture, building, and a separate accumulated depreciation account for each of those major categories. Or QuickBooks right here just has a lump sum accumulated depreciation for the entire thing. So that's up to you as to whether you want to break that out. I would ask your tax preparer or accountant, and I would typically mirror what the tax code is if you're a small business in terms of the categorization, because that's going to be the easiest thing to do and line up with if you're using the tax return in order to record and track the detail of your equipment and your accumulated depreciation. And so the reports will line up as easy as possible that way. So I'm going to go to the accounts, going to edit this one. And so once again, all we need is the beginning balance. So then here's the problem. Do I enter it as a positive number or a negative number? I don't know, because it's a contra asset account and we're not talking debits and credits. And so what do? I'm just going to put 7,500 positive and see if I need to change it. So then I'm going to say 12/31/20. And so that's the day before our cutoff. So I'll say okay, save and close that one. And now let's check it. There it is right there. Let's check out the balance sheet. Notice that these both are fixed asset type of accounts, even though this is a accumulated depreciation and this is a furniture and fixture. So if I go into the balance sheet here, it should refresh. And notice we have that same problem. Like within this little category, I can collapse it and it looks nice together there. But when I expand it, if I want to see it that way, notice I would rather have the furniture and fixture up top, but I can't do that. I have no way to put it up top without account numbers. So that's why the account numbers can be useful to categorize this properly, because it went into alphabetical order and put the accumulated depreciation before the depreciable asset, which is weird, but it's okay. We might talk about account numbers later. If I double click on that 7,500, then we're going to get into the detail. So it's a journal entry because once again, there's no set form for calculating the depreciation. It will typically be done with a journal entry. If I double click on that and have a double click on this little journal entry thing, there's the journal entry. So there's the journal entry. This is the default form. If there's no other data input form, QuickBooks will use. The other side clearly going to opening balance equity. Closing this back out, closing this back out. The other side's in opening balance equity down at the bottom here. There's opening balance equity. If I double click on it, we then see that 7,500 there. All right, closing this back out. Now note that I actually went the wrong way because it added it. Now we're at 82,500. That's how I know it went the wrong way. So QuickBooks did want me to put a negative in there. Now I can't go back to the opening balance screen to fix it. I have to go into the data input screen that QuickBooks gave me. So I'm going to go, all right, it went the wrong way because it's a contra asset account and they didn't use debits and credits. So I don't know if it's a negative or positive. So I'm going to double click on it and I'm going to double click here and I'm just going to switch the debits and credits. See, the debits and credits are more specific. I wouldn't have that problem if we used debits and credits, but when you use plus and minus, you have that problem when you're dealing with like accounts like a contra asset account. So we're gonna say, all right, let's just put just do it that way. So, and I don't care that the debit's on the bottom and the credit's on the top, as long as the debit and the credit are assigned to the correct account. And if they're wrong, you just switch these two. So, right, so the accumulated depreciation goes up with a credit, opening balance is the other side. So I'm going to say, all right, okay, yes, and then close this thing, and then close this, and now that's a negative number. That makes sense. So now this should be 67.5. So that makes sense. So that looks good. I think that's good. Okay, so now we're going to go back over, and of course the other side flipped down here in the opening balance equity as well. Okay, so now that one is done. So I'm going to highlight that and say that one has now been completed. So let's right click on that. I'm going to make it yellow. And we're going to go to the credit card. So I'm going to go to the credit card. Let's make that green. So this one, you'd want to get, you have to take it from our statement here so we line up, so we'll be in balance with the beginning balances. But it's also going to have to line up with the credit card statement. So this is another area, kind of like the checking account, where we're going to have to deal with any kind of problems with that balance, that beginning balance, when we get to the statement, when we kind of like reconcile the credit card. So I'm going to go to the chart of accounts again. And let's see, that would be a liability account, the credit card. But I don't see anything here that says credit card. So we don't have one yet. So I'm going to say, all right, we don't have one. So I'm going to add one. Let's go to the account, rise up, and go new account. And we want a credit card. So it has a custom credit card area. Now this, you could use another current liability, but this one allows you to kind of do the reconciliation process in a similar way as you do with the bank accounts, which is going to be an important process, especially if you do not pay the credit card off each month. If you don't pay the credit card off each month, it can be kind of confusing to do the credit card. We might do a little bit more just specifically on credit card tracking after this practice problem. So I'm going to go to the credit card and we'll say continue. And so the credit card name, I think we just called it credit card, so it's a generic. Now, obviously, it's similar to the bank, so you might want to put, American Express or whatever it is. And then also, maybe if you have more than one credit card, the last 4 digits of the number. You don't need a sub-account typically because you'll be able to collapse this in the credit card account. So you don't need a sub-account unless you want more, detail. You could call it a credit card account and then have sub-accounts of the credit card account, like American Express, Visa, and so on. And then I'm going to enter the opening balance. So I'm going to enter the opening balance here, which is, I believe it was 1,000 for 12/31/20. So there we have that. That looks good. So I'm going to say OK and save and close. And set up online services to save time. I'm not going to do that. That's bank feeds again. You could do bank feeds for the credit cards. Not going to do it now. We'll talk about bank feeds after this practice problem. You don't want to do them unless you understand a little bit about the bookkeeping first. It'll get confusing. Okay, so we have the credit card down here. So once again, it's in the credit card category. So you could collapse it up top. If you had more than one credit card and you named it like American Express, you can collapse it and print the report without that there. So I'm going to say double click on this one. And there it is. It's credit card. If I double click on that item, we're going to get the type of form, which is a credit card charge. So there's the credit card charge. Other side going to opening balance equity, as would be expected. So if we go down to opening balance equity, we see the other side being dumped in there by QuickBooks as we enter these opening balances. All right, so that's going to be the credit card. Let's go back on over and say, all right, that one, let's make that one yellow. Now we have a loan. We're going to assume this is like a bank loan that we have. And that's the I won't even make it green because we're getting close. That's the 22,000. It's just going to be a loan payable. So I'm going to say, all right, loan payable, chart of accounts. That would be a liability account. We have a current liability. We have sales tax, and we have payroll. No loan payable. I'm going to make the loan payable a long-term liability. So I'm going to say it's going to be due after a year's point in time. Now, the loan payables, you got to be a little bit careful with them as well because, oftentimes if we pay them off monthly, and the loan extends for more than 1 year, to be completely proper under an accrual basis, you should have a short-term and long-term portion of the loan. But that becomes burdensome when you're just trying to enter the loan balance. So I would then enter it as either short-term or long-term, and then do an adjusting entry at the end of the time period for the short-term or long-term to break out between the two. Also note that you might want a separate loan account for each loan that you have, because that will make it easier for you to track it within the system, or you can kind of group all the loans together in one loan account, and that'll make it easier to make reports. But then you're going to want some more sub-ledger kind of accounts to track, the loans that are included in that account. I think breaking them out is going to be easier for most bookkeepers to most accountants to kind of break. That's what I would do. Break it out so you can see the multiple loans, and that'll be as clear as possible within the accounting system. So I'm going to say the account drop down, rise up. I'm going to add a new account. Now, note you could make it a current or long-term type of account. They do have a loan account that could have some tracking options with it as well. So let's set up the loan account here. I'm going to set up the loan account, and I'm going to say continue. And so then we're going to set up the account name. I'm just going to call it the generic loan payable. And again, you might want to label it more detailed than that for the loan, and then the last 4 digits of the loan number, especially if you have multiple loans that you will be tracking. So description, I'm not going to put anything here. Opening balance, and notice what it put it in here as other current liability. So it's grouping this one. We picked the loan as an other current liability. So it's not a long-term liability, it's a current liability, and you'd have to break out the long-term portion if you need to. Now, sometimes if you have a very large loan, I would rather see it in the long-term liability, but sometimes they restrict us from making payments out of a long-term liability account. So it's kind of safer, depending on what tax software you use, to group all the loans as current liabilities, and then do the adjustment yearly to break out the long-term portion of it if there's a short-term and long-term portion, as there would be if you make monthly payments on a standard installment loan and the loan extends for more than 12 months. All right, so then I'm going to say opening balance. We're going to pick that up, and that's going to be the amount of $22,000. So $22,000, and that's for 12/31/20, and okay. So let's go ahead and save that and check it out. So we're going to go back to our balance sheet. So there's our loan payable. It's under other current liabilities. So it's under other current liabilities. And so again, note that this is one that if you have multiple loans, you might want to use that sub-account thing to add one account called loan payable, and then add multiple loans under it, naming the bank and the last 4 digits of the loan number so you can identify them. And that'll give you this little handle that you can then collapse the column, which might make it easier for printing and presenting the reports. I like having the loans broken out for my internal data input, and then you got to think about presenting the reports, making that as easy as possible. Those sub-accounts can be useful for that. If I go into the loan payable, then we're going to say there's the loan payable. It's a general journal type of form, because again, the loan isn't something that happens every day. Therefore, there's no standard data input form for it. If I double click the journal entry here, there's our journal entry crediting the loan payable, debiting opening balance. Other side going to opening balance then. Oh, closing this back out, closing this back out, closing this back out. If we go into opening balance equity, we'll see the other side. It dumped the other side, as we would expect, into the opening balance equity. So we should be good now. We should be lined up here. So let's just check it out. If I go back on over to this, let's see if I can put this on a side-by-side type of thing. Will that work? Side-by-side view. Close this thing out. So we've got the $25,000 in the checking account. That looks good. We got the $20,500 on accounts receivable. 2896 there. We've got that looks good. The 75,000, and then the total assets are at the 115,896, which we can't see here because if I won't do it. And then down here we've got the 15,000 in the accounts payable, 1,000 in the Visa card, loan payable at the 22,000, and then down here with the opening balance, total balance is correct at the 77,896, which we knew it would be. You're probably doubting us on that one, that would actually happen, but it does, because we found all the balances everywhere else. Therefore, total equity is correct. However, the breakout between the equity is not correct, because this opening balance account is a made-up account. So we're going to move it from that account to like a capital account for the for the equity. And note, if I maximize this and I go to the next day, one day up, January 1st, 2021, you can see that the retained earnings turned into the owner's equity. That's the account that QuickBooks will use since we chose a sole proprietorship to roll out the balances into. So I'm simply going to move in a future presentation the opening balance into the owner's equity account, and then everything should be good going forward. If you're using like a partnership, then you're going to have to break it out between the partner's capital accounts. However many partners you will have those many capital accounts, and you will have to move the amount from the opening balance into those capital accounts.